Today is Tuesday, April 2026, and right now Wall Street is currently valuing the prediction market industry at like $15 billion.
Yeah, it's a massive number.
Right. But to justify that kind of valuation, the traders inside those very markets are putting millions of dollars on the line, betting on, well, basically a total collapse of global stability.
Which is quite the contrast.
Exactly. We are looking at a landscape where this record-breaking institutional optimism is being fueled almost entirely by bets on, apocalyptic ground-level crises.
It is a phenomenal paradox, really. I mean, the business of forecasting the future has never looked brighter, but the actual future being forecast has, well, it's rarely looked darker.
Yeah, and we know you are looking for perfectly distilled, high-signal information without having to wade through the usual noise of cable news pundits. You want to see what the world actually looks like when people are forced to put their money where their mouth is.
Which is exactly what prediction markets force you to do.
Right. So for this deep dive, we are pulling apart a highly detailed market update report from today. It tracks the explosive volume and the specific capital flows across the major prediction markets, primarily, Polymarket and Kalshi. Okay, let's unpack this. We have to start by looking at the institutional plumbing that is currently being built underneath these platforms.
Absolutely, because that's where the real shift is happening.
Yeah, and the biggest trending data point today is that Polymarket is in active talks to raise $400 million. And this is at a staggering $15 billion valuation.
Which is a number that, I mean, it forces traditional finance to pay attention. But you have to remember that valuation does not exist in a vacuum. It comes directly on the heels of the $600 million strategic investment we saw last month from ICE.
Right, the Intercontinental Exchange.
Exactly.
A parent company of the New York Stock Exchange.
Yeah.
I mean, with ICE writing a check that large, they're essentially stamping this whole space with an institutional seal of approval.
Yeah, they're laying down the tracks for mainstream adoption.
And I look at this and I don't see the old metaphor of prediction markets being just, unregulated Wild West casinos anymore. To me, this looks a lot more like a global insurance underwriting desk. You have retail and institutional traders suddenly working together to price the premiums for global chaos.
That's a great way to frame it.
So, are we witnessing the exact moment these platforms cross over from niche speculative tech into fundamental mainstream financial instruments?
Well, what's fascinating here is how that institutional money fundamentally alters the perception of counterparty risk. I mean, when you have the parent company of the NYSE stepping in, you are integrating with the very plumbing of global finance.
Right, it's not just a crypto project anymore.
Exactly. And we can actually see traders reacting to that structural shift in real time. Over on Kalshi, there's a massive surge in trading volume within their specific regulatory action markets.
Wait, so traders are basically front-running the regulators?
Pretty much, yeah. They are actively putting capital down on whether the CFTC...
The Commodity Futures Trading Commission.
Right, the CFTC. They're betting on whether the commission will broaden its approval for more complex prediction contracts.
Wow, so they're betting on the business of betting.
Yeah, the underlying logic being priced into the order book is simple causality. I mean, if the institutions are fully committing their capital to the infrastructure, the regulatory bodies are highly likely to legitimize the asset class.
Makes sense.
So traders are buying up contracts on CFTC approval because they believe the institutional backing essentially, it forces the regulatory hand.
Which creates a self-reinforcing flywheel. Like, the institutional money validates the platform's infrastructure, which drives traders to bet on regulatory approval.
And then attracts even more institutional capital. Exactly.
Right. But there is a massive structural irony here. If these platforms are the newly minted, fully validated insurance desks of Wall Street, we really have to look at the actual events generating all this trading volume. What are the high rollers actually pricing in?
Yeah, and this is where it gets heavy. The optimism of the business model is currently colliding with a grim macroeconomic reality. We are seeing a distinct shift into what market analysts call a conviction phase regarding domestic gridlock.
Okay, let's look at the domestic data first, because it's pretty alarming. The market for a U.S. government shutdown lasting at least 100 days.
100 days.
Yeah, which would drag this crisis all the way into June. That market has surged to a 54% probability. We are looking at better than coin flip odds that the government just stays effectively closed for over 100 days.
And that number is not just floating on general sentiment, It is tied to very specific procedural mechanics.
Right. It's not just people feeling bad about politics.
No, not at all. Traders are reacting to the daily friction of the legislative process.
Yeah, and the report gives a perfect example of this. The odds for the Department of Homeland Security being funded before May 1st have completely collapsed in the last 24 hours. They're sitting at just 11% today.
A huge drop.
And the catalyst for that drop was purely procedural. The Senate returned to session yesterday and produced absolutely no new legislative text.
They came back empty-handed.
Exactly. Traders saw the empty docket and instantly punished the odds, stripping the probability down to 11%. But the domestic gridlock is really only half the story here. The international markets are pricing in something much, much heavier.
Yeah, the geopolitical contracts are showing aggressive velocity right now.
Yeah, look at this. On Polymarket, the probability of, quote, U.S. forces entering Iran by April 30 has spiked to 86%.
86%, that's almost a certainty in market terms.
And this follows the morning reports of ground clashes during a rescue mission. But what really stands out in the report is the sheer speed of that movement. That contract was sitting at 71% just last week.
Right.
A 15-point jump in a matter of days indicates a massive influx of capital banking on military escalation by the end of the month.
It's an incredible amount of volume.
Concurrently, the market for normal shipping traffic in the Strait of Hormuz by May 1 has crashed down to a 21% probability. And that crash triggered immediately after a 30-day sanctions waiver expired on April 19.
So the market is aggressively pricing in a prolonged blockade.
Exactly.
The capital is moving in lockstep with the expiration of those specific diplomatic windows.
But, here's where it gets really interesting, and I have to push back a little on what this data actually represents.
Okay, go ahead.
When we see a market predict a 100-day government shutdown at 54% or an 86% chance of military escalation in Iran, are these markets actually predicting the future, or are they just an echo chamber reflecting our current collective anxiety?
The echo chamber argument.
Yeah, if every trader is doom-scrolling the same scary headlines, aren't they just putting a price tag on their own irrational fear?
Well, if we connect this to the bigger picture, we really have to look at the mathematical mechanics of what a conviction phase actually means in an order book. It is crucial to separate public polling from market liquidity.
Okay, how so?
Think about it this way. When you answer a poll about global stability, it costs you absolutely nothing to express pessimism. You read a frightening headline and you vent your anxiety.
Right, it's just talk.
Exactly. But in a prediction market, expressing an unfounded emotion is basically a mechanism for wealth transfer. You will lose your capital to someone more objective.
Because you are tying up real liquidity.
Yes.
Like when a trader buys a yes contract on a 100-day shutdown at 54 cents, they are locking that capital away for months.
Mm-hmm.
And if a funding bill suddenly passes tomorrow, that 54 cents evaporates to zero. The opportunity cost of holding that position is massive.
That's spot on. Let's take the 86% probability on U.S. forces in Iran. The architecture of an order book is nonlinear. Moving a market probability from, say, 40% to 45% takes a relatively modest amount of capital. But moving a market from 80% to 85% and holding it there against the resistance of opposing traders takes exponentially more capital. To push a geopolitical market to 86% requires millions of dollars in sustained liquidity just to absorb anyone betting the other way.
I see. So if that 86% was just an irrational echo chamber overreaction from retail traders reading the news, the smart money would aggressively step in.
Exactly.
A massive quantitative hedge fund would look at that, determine the true baseline probability of war is only, say, 35%, and they would dump $50 million on the no side.
Yep. They would happily collect the panicked retail premiums and crush the probability back down to reality.
But they aren't doing that.
No, they aren't. And the absence of that correction is the signal. The fact that institutional capital is not stepping in to correct the fear, and that the probability continues to hold firm at 86% demonstrates that the collective intelligence of the market genuinely calculates the risk to be that high.
It's just ruthless agnostic math.
Exactly. The market does not care about the political optics of the Senate or the ideological implications of foreign policy. It only cares about the physical mechanics of the outcome.
Wow. But, There is a glaring structural problem here for the platforms themselves.
Which is?
Well, if the traders are locking up hundreds of millions of dollars, waiting 100 days for Congress to act, or waiting weeks to see how a blockade in the Strait of Hormuz plays out, aren't these prediction platforms going to eventually choke on their own stagnant liquidity?
That's a very real risk, yes.
Right.
Yeah.
If every dollar is trapped in a long-term geopolitical crisis, the platforms starve. They desperately need a fast turnover mechanism to keep capital flowing. And that brings us to the hardwood.
The sports markets, they act as the necessary velocity engine for the entire ecosystem.
Yeah, the NBA playoffs are providing a massive retail oasis for this locked-up capital. We are right in the thick of the first round, dealing with the volatility of Game 2 adjustments, and the sports volume across these platforms is just shattering daily records.
It's a fascinating contrast to the heavy, slow-moving geopolitical data.
Completely. On Polymarket, the 2026 NBA champion market holds over $231 million in volume. You've got Oklahoma City sitting at 47% and Boston at 31% as the clear favorites.
But the real frantic energy, the day trading environment, is happening on Kalshi for tonight's specific slate of games.
Oh, yeah, where the resolution times are measured in hours, not months.
Exactly.
You have the Raptors versus the Cavs at 7:00 p.m. Eastern, where the Cavs are heavily favored to go up 2-0.
Right.
You have the Hawks versus the Knicks at 8:00 p.m., which has seen huge volume specifically on the point spread. Traders are fiercely debating whether the Knicks' home court resilience holds up under playoff pressure.
It's a highly volatile spread.
And then at 10:30 p.m., you have the Timberwolves versus the Nuggets. Now, the report explicitly highlights this Timberwolves-Nuggets matchup as the quote-unquote pro favorite. There is huge money coming in on the Nuggets to bounce back after a tight Game 1.
Yep.
So why does that one specific game suddenly attract the professional algorithmic money over the others?
Well, this raises an important question about market inefficiency and arbitrage. Professional traders are not betting on team loyalty, They are hunting for pricing inefficiencies in the order book.
Okay, so how does that play out in Game 2?
When you have a blowout game with a massive point spread, the variables are relatively static. But a tight game like the Timberwolves and Nuggets, especially following a close Game 1, introduces high volatility in the micro-adjustments.
Oh, I get it. They are trading the variables.
Exactly.
So algorithmic models are scraping injury reports, defensive matchup changes, referee assignments, and then adjusting their own internal probabilities microsecond by microsecond.
That's it. Professional money floods into tight point spreads because those specific conditions create momentary gaps between the true mathematical probability and the public's betting sentiment. If the public overreacts to a single missed shot in Game 1, the pro money exploits that overreaction on the spread. But beyond the arbitrage, it really comes back to the concept of capital velocity we discussed earlier.
The pressure valve.
Yes. A basketball game resolves in exactly 48 minutes of regulation time. A quantitative trader can deploy a complex analytical model on how the Nuggets adjust the pick-and-roll defense, execute the trades at 10:30 p.m., and have their entire capital base plus their alpha return to their account by 1:00 a.m.
And then they can just wake up the next morning and deploy that exact same capital into another market.
Precisely. You cannot achieve that kind of rapid compounding velocity in a geopolitical market where the diplomatic timeline is entirely opaque.
Right. It's a clean, bounded environment. Like if you spent your entire morning modeling out the economic fallout of an expired sanctions waiver in the Strait of Hormuz, pivoting to trade the Knicks point spread is almost a therapeutic palate cleanser.
That's a good way to put it.
It's clean, rigid data. The rules of a basketball game aren't going to suddenly change in the third quarter because a committee chairman refused to draft new legislative text.
Exactly. And the ecosystem requires both sides to function. The sports markets provide the fast-paced, high-velocity liquidity that keeps the daily active users engaged, while the macro-level crisis markets absorb the massive long-term institutional capital hedges.
So, bringing all of this together to look at the complete board, we're examining this specific date, April 21st, 2026. And it serves as a perfect high-resolution snapshot of institutional optimism colliding with ground-level reality.
It really does.
On one side of the ledger, you have a $15 billion valuation, a $400 million raise, profound integration with ICE, and traders aggressively front-running CFTC regulatory approval. I mean, we are watching the real-time birth of a new pillar of Wall Street.
But the foundation of that very pillar is being stress-tested by profound instability.
Which is exactly the paradox we started with. The volume driving that $15 billion valuation is built on 86% probabilities of foreign conflict, 100-day government shutdowns, and a global shipping network that appears to be fracturing. All while the retail crowd pours hundreds of millions of dollars into an Oklahoma City basketball championship just to keep the capital velocity moving. So what does this all mean?
Well, for you, listening to this right now, it means that observing these prediction markets is rapidly becoming the ultimate shortcut to being a truly well-informed person.
Yeah, that makes sense.
We exist in an era of unprecedented information overload. Every news network has an angle. Every social media feed is an algorithmic echo chamber.
It's exhausting.
It is. But the prediction markets strip the punditry away completely. They show you exactly where the smart institutional money believes the world is heading, stripped of all noise.
Because the money doesn't care about the narrative.
Exactly. If you want to understand the true state of the U.S. Senate or the actual risk premium in the Middle East, you do not need to consume hours of commentary. You just look at the probabilities on the order book. It is a brutally honest, mathematically rigorous reflection of reality.
A $15 billion mirror held up to the world. But, looking at that reflection leaves me with one final, slightly unsettling thought for you to mull over.
What's that?
Well, we have established that these heavily funded prediction markets are becoming incredibly accurate mechanisms for forecasting disastrous real-world events. 100-day shutdowns, military escalations.
Yeah.
As these platforms become deeply embedded in the mainstream financial system and highly trusted by the establishment, will policymakers start using these very same public markets as an early warning system?
Oh, that's an interesting thought.
Like if a sitting president looks at a terminal and sees an 86% probability of an escalating war, do they preemptively alter their foreign policy to avoid it?
Yeah.
And if they do change course, making the predicted event not happen, does the prediction market eventually become a self-defeating prophecy? Think about that the next time you look at the odds.